Hey everyone, thanks for joining us today. We're going to get ahead and get started in about 3 minutes or so. Give everyone time to grab a drink, grab some snack, coffee, use the restroom. In the meantime, definitely use the comment on the chat function to introduce yourself to the panelists and let us know where you guys are from. Thanks. Hey everyone, thanks for joining us today. If you haven't done so, definitely share your LinkedIn profile and connect with the other attendees in the chat. For later today, when we get to the Q&A portion, you can send your questions into the chat as well, and then we'll be sure to try to pull them up for Chris, Josh, and Jordan and Dave to answer. So without any further ado, I'm going to welcome Josh, our CEO and founder, to come up, talk a little bit about Capital Factory.
Awesome. Hey, thanks, Trent. Welcome, everybody. This is our intro to investing and AMA, Ask Me Anything. And we have incredible guests tonight with Dumb Money. I'm really looking forward to talking with this crew who I've known for a long time, and we've done quite a bit of investing together with. For those of you who may not be familiar with Capital Factory is the center of gravity for entrepreneurs in Texas. We have classes and co-working and events and all kinds of programming like this happening every day, both in person and online. Big space where people work together when they can be together, and then connecting them together, through Slack and virtual ways as they can now. And a big mentor network that sits on top of that with hundreds of entrepreneurs helping each other out every day. And then we have a team across the state in Austin, Dallas, and Houston, their job is to meet all the best startups, find them, get them plugged in, and then help them meet the people they need to meet most: investors, customers, employees, talent, mentors, partners, the people that help them get their business started and moving forward. And we watch all of that. We see, we kind of help everybody at once, watch everything going on. And that's how we invest. That's how we figure out which companies to invest in. And so we're constantly investing in all these companies. And for the past, more than 5 years, we've been the most active early stage investor in Texas. So last year, almost every week, we were investing in one of the companies going here through Capital Factory. And it seemed like once a month, it was doing one with Dumb Money. So glad to have you all here today. We're going to talk a little bit about angel investing or investing in general, but angel investing in particular, and from the investor's perspective. And if you want to learn more, I can go to capitalfactory.com. You can also sign up for, if you're an investor and you want to meet companies, we would love to introduce you to some. We've mapped them all out. We've got hundreds of all the best companies in Texas. And so when we interview you, get a little bit of an idea of what you're looking for, and then we can help make intros for you. And you can register for that for our investor network at IR for investor relations, ir.capitalfactory.com. So, what else? I'm just talking, but then there's slides going here in front of me too. I think Tret's trying to keep up with me. But what's the VIP Accelerator? So hey, the other main way for the startups that might be listening, because I bet there's some startups and entrepreneurs listening here trying to get some tips about how to raise money. For the startups, the best way you get them plugged into Capital Factory is through our accelerator. And you can start by just joining as a member. And anybody who's an entrepreneur and who's working in tech can join as a member. And through that, you get access to our online community, to our Slack, to our physical spaces, to our co-working spaces, and you get the access to the mentor network in particular, to be able to go book time to meet with some angel investors, but lots of other entrepreneurs and subject matter experts who can help you figure your business out. And then when you're really ready to raise money, you can join our accelerator, which is really about finding the best companies and getting them connected to investors, customers, and talent, like I was saying before, to really help push them forward. Tret, I know you got a deck that you're running with, so I'm kind of seeing this. I'm seeing the slides come up, and I'm predicting. But I'm just going to do one more, which is I know the next one that you have, and then we'll jump into the presentation here, and that's our Texas Startup Manifesto. And that's really, it's not actually how I first met Dumb Money. I first met Chris Camilo from Dumb Money many years ago, in the early days of Capital Factory, as he was helping get involved in starting an accelerator up in Dallas. But really, as I got to know him better and the rest of the team, was as we really launched our Texas Startup Manifesto, reaching out from Austin to Dallas and Houston and San Antonio and really all across the state. And the Texas Startup Manifesto basically says that if you're a startup, if you're an entrepreneur, you should treat the whole state like one big city. That's really what it all comes down to. That there's really nowhere else in the world where you have these 4 cities: Austin, Dallas, Houston, and San Antonio, 4 of the largest cities in the country, 4 of the fastest growing cities in the country, and 4 of the top tech hubs in the country, all before COVID-19. And I promise you, if you just looked at those stats over the past 3 months, post COVID-19, guess what? It's even more. It's everybody's moving here from the coast and from other big cities. And so these places are booming and growing, and yet they're all so close together. You can be in any one of these cities, particularly Austin, but really any of them, and you can get to any one of the other cities just for the day. I can go to Dallas for the day. I can go to Houston for the day. I can go to San Antonio for the day. And so I don't have to just fish in the pond of Austin. I can go recruit talent in any of those cities. I can go talk to investors in any of those cities. I can go sell to the big companies in any of those cities. And that together is pretty huge. If Texas was a country, its economy would be the 10th largest country in the world. It's big. And so this is a great place to be. If you're launching a product that launches market by market, you've got 4 huge markets, and you can have a headquarters in one and service all 4 markets. There's very few other places like this where you can do it. And so that's really what the Texas Startup Manifesto is about. We started it 2 years ago, expanding to Dallas, and then last year to Houston. And we've always had a great relationship doing lots of things in San Antonio. And we've really seen the results of that, because last year, about a third of our companies came from Dallas. And so we're seeing lots of the companies that we're working with coming in that way. So thanks. That's a little bit about Capital Factory. And next up, we're going to jump into the intro to investing. And that's what we all came here for. And so, there's lots of different ways to think about investing. There's lots of different things to invest in. There's crowdfunding now. There's obviously the stock market. There's professional investors, venture capitalists, and fund managers, and private equity. There's all these different categories of money, depending on how much money you have and how you manage it and whose money it is and what you invested into. But what we're going to really focus on today is startup investing, mostly tech and kind of consumer CPG startup investing, and really from a mostly individual perspective, from what we call an angel investor. So, and that's a big part of how I got involved in investing. That's, even though I have a fund and I'm technically a professional investor, I actually invest much more like an angel investor still. And that's a lot of how I think about the way that Dumb Money invests. So we'll see if I'm right as they tell us a little bit more about it today. And so let's go ahead and bring Dave and Jordan and Chris all online with us here. Hey guys, it's awesome to have you. This is the Dumb Money crew, and I'm a big fan of Dumb Money. I've been watching since it started, and I've known the crew since before then. But we're gonna, just to introduce all of you, talk a little bit about your backgrounds, a little of your entrepreneurial journey. How do you become an angel investor? Everybody wants to be one, but how did you become an angel investor? And a little bit of why that gives you some credibility and some insights in being a good angel investor. And then we want to talk about investing itself, how you guys find companies to invest in, how you think about it, talk about some specific companies you invested in the unique way that you go about it. So thank you all for joining us today.
Thanks for having us.
Happy to be here.
Awesome. Great. Well, hey, let's start with your, quickly looking at each of your own entrepreneurial journeys. And, I know of you as all working together. Was that your first business, or did you all work on businesses before then?
Well, Chris and I have known each other since high school and have started little businesses, many of which were never serious, but, and we failed miserably at it. But I think that, we've kind of always seen working as a team as part of what we do. And we got introduced to Jordan through probably our first successful company, eCarList. And he's been amazing and has been with us ever since.
So let's talk about eCarList. What was your
so eCarList was a company that eCarList was a company that I started with Len, which is a mutual friend of both Chris and Dave. And basically, Len was a car dealer, and he was trying to figure out how to get his cars online. And I think Dave helped out with this a little bit too, but I ended up writing a bunch of software to automate that whole process. And when I graduated from college, Len was like, hey, this is like a growing bit right now. People are trying to do this. Companies are trying to compete online by selling cars. And so he's like, why don't you quit your job and let's start a company? And so I was young and dumb, and we did, and it ended up working out.
Yeah, and I think what was fascinating about that, Dave was at Yahoo at the time. You've been at Yahoo you spent about 10 years there, right?
10 years,
Dave?
yeah.
Helping run Interactive, the broadcast, the Dallas division of Yahoo. I was helping build a company called eRewards here in Dallas at the time. And we were all looking to do something that was just ours, right? We had been building companies for other people for a while. And I think that's kind of the natural progression. You get to a point where now you get to build your own. And we joined Lynn and Jordan and built eCarList, eventually sold that to a publicly traded company. Never took venture capital, actually. It was just about $100,000 that we had in the company. And we had a really nice exit about 5-6 years later. And then, what happens at that point, you have that big exit. What do you do now for the rest of your life? You could technically probably get by for a really long time without doing anything, but you don't want to do nothing, but you don't want to rush into a new company because you don't have any amazing ideas. So there's this natural progression where people that have these exits, a lot of people in the industry, people look to you as, wow, well, you had the exit. Can you help me now? Can you just help advise me, consult me? And that quickly turns into a conversation about, maybe I should invest in you too, right? And that just kind of starts, and it evolved really slowly. Before you knew it, going into 2019, we probably had 25 investments, 30 investments in startups. And you said, Josh, you were investing in at least a company a week or more at Capital Factory. We were investing in a company every other week last year. So I think we did 24, 25 investments in startups last year. That was the busiest year we've ever had. And it just naturally evolved. You know how it is, Josh. You get in this space, you meet more people, more great ideas, more great people. The funnel gets bigger. And I have to say, it's just learning. It's like, how much did we learn last year? How many mistakes do we make last year trying to turn the nozzle up that big? I mean, there's a few deals we would have went back on, not done probably, right? But the only way to learn this game is just to do. And now that we have over 50 investments in startups, we're still learning every week. Certainly, we took a few months off here with COVID this year. We're really more concentrated this year on investing in publicly traded companies. But I think not in the not too distant future, we're going to rapidly shift back to startups again. And Capital Factory has been the biggest part of our startup life. I mean, literally, you guys are the funnel for dumb money. I mean, I would say probably 70% of our investments, 60 to 70%, are initiated through Capital Factory, the Capital Factory process. And I see that continuing, quite honestly, for the next many years to come.
Love to hear it. We love connecting you guys. And we know and one of the reasons we love doing it is because we know when you put money in, it's not dumb money, that actually you're super helpful. And they're going to be more successful because of it.
By the way, Josh, just so you know that people have asked about the dumb money name. We call ourselves dumb money because we're technically not, we're not the traditional pedigreed, Silicon Valley venture capitalist. We didn't go to Wharton. We didn't trade stocks on Wall Street for big hedge funds. Yet, we've had more success than almost anyone in the space, either on the public side or the private side. And we really want the whole world investing, right? Like, I think it's great that we invest, but I think anybody has the ability to start investing at some point in their life, whether it's a person that they know that they went to college with, or a good friend, or someone that they really have a lot of faith in, or just getting involved with some place like Capital Factory, listening to pitches for a couple of years until you get to a point where you're like, I can do this. I can put a little bit of money into a startup. Everybody's dumb money. And I think dumb money is plenty qualified to do what we do.
So let's talk about why you invest. So if you're a venture capitalist, if you're a professional investor where like that's your job and you're managing someone else's money, like that they're giving you to go invest, that's how I traditionally would think of a venture capitalist. They go raise money from limited partners, from big, endowments, universities, high net worth individuals, but their job is to go deploy the money, and they kind of like have to spend it in a certain amount of time, even, versus an angel investor. And, you guys maybe fall somewhere in between, but you're more an angel investor, I think, where you're probably investing your own money primarily. Right. You don't have to do it. Like, you could take a couple months off because COVID hits if you want, or you could, instead of making this angel investment, you could go buy a new car, or do something else, right? You have a lot of choices. And you're more of an individual. That's kind of how I think as the difference. Do you think that's a good way to think about it? How do you think about the difference between angel investors and venture capitalists or other professional investors?
Yeah. And we're probably somewhere kind of in between. We do invest our own money, but the amount that we invest cumulatively probably is closer to like a fund, but we're not a fund. We invest our own money. We are very active. We meet with a ton of companies. We'll invest in absolutely anything. I think that a lot of the professionals who do this are more laser focused on one specific thing, but we'll invest in anything: startups, stocks, real estate. We're building a consumer brand right now for a cookie company. So it kind of anything goes.
You're investing in dumb money too, right? That's
yeah. And I think when you say why, I think your initial question was, why do we invest? Well, this is our full-time job now, right? And our full-time job is just investing. We just happen to do it for ourselves instead of investing other people's money. It gives us more flexibility. Certainly, we don't have parameters. And quite honestly, we get to have a little bit more fun doing it because we don't have any rules, right? We can be stupid, we can be unprofessional, and we are very unprofessional quite a bit. But you know what?
And we're completely transparent about that unprofessionalness. You know, we share it with the world, trying to help the next generation of investors kind of see what we do, learn from our mistakes, learn from our successes, and maybe be able to have their own success.
But yeah, but I think more than anything else, I think investing to us is more than a job. It is actually everything to us. I mean, it's not just about us making money off of our investments. Your money is power in terms of your influence over shaping the world around you and shaping your generation. So when we choose to make an investment in Pressed Roots, which is a Capital Factory company. It's a very recent investing, maybe a bad time one because it was a brick and mortar investment. It literally closed the week before COVID started, but an amazing company because 1, it was female owned, 2, it was Black owned, 3, it was providing a service that no one cared enough to provide, to a certain demographic in terms of being able to have a certain type of hair care that demographic wants, but nobody wanted to create that. So by us investing in that founder, we are literally we're shaping the future of hair care for a certain demographic. We are invested in a company, another Capital Factory company that is, I think, all three of ours current favorite right now. We're about to close very soon, Lazarus 3D, which they essentially make simulated, basically exact mirror image of your organs, your heart, your liver, with a proprietary material so that surgeons can practice on your tumor before they do surgery on you. And we had this meeting with the Lazarus 3D founders, and I walked out, I'm like, yes, I think it's a great financial investment. I think it's a superb financial investment. But my God, we're going to save lives. Like by us funding this company, we are actually 100% going to save a lot of lives. Because if you start to study the error rate with surgeries, with young surgeons and complex surgeries, I mean, that's something that we're doing as investors. So like, it's way bigger than just the financial benefit you get. I think investing is everything. Like you want to invest.
Yeah, you skipped over a little bit. When you say your in that scenario, they actually mean your. They take your MRI, your exact anatomy, and they let the surgeon practice on you before they go in and perform the real surgery on you. It's a big deal.
Yeah,
it's a big deal.
Company, you want to share with everybody do you know what doctors practice on right now without that?
Yes, the doctors literally practice on fruit. Okay. Or more often than not, they practice on nothing. A complex surgery, they will sometimes get a hard model of that organ and just look at it. They will look at it and they'll be like, we should approach from that angle. Where with Laz 3D, they literally do the surgery on a soft tissue mimic organ. It's mind-blowingly cool. But like other people, like I know there's a lot of younger investors, people never understood Tesla and why people are investing in Tesla. I know this isn't a startup necessarily, but if you want to electrify the world, maybe you make money along the way, great. But no better way to say, you know what, we're not waiting for the government to subsidize this. We're not waiting. We're going to give Tesla our money. We're going to give this next thing our money as a generation and influence how the world unfolds as an investor. And I think that's the one piece of investing that young people don't understand how much power they yield by controlling their own investments, whether it's doing it themselves or doing it in partnerships with smart VCs that can maybe invest for them. Because I know, like, you're a venture capital, you're a venture capitalist, Josh. I think you probably have lots of LPs that are watching what you do with their money, and over the next 5 to 10 years are probably going to start investing on their own in addition to the money they're invested in, right, with your venture fund. So it's not either or. I think it's an ecosystem where you kind of learn through others. I'm invested in 4 or 5 different funds, and they're funds that I'm learning from all the time, right? I'm learning from those, venture investors, and there's no end to learning. You know this. Like, I can do this for 100 years, and I'll still be a quasi okay early stage investor. Right? That's how hard it is trying to get this right.
Let's talk about the team for a minute. So there's 3 of you. How do you guys divvy things up? Because you're all kind of different. So like, all right, Chris, you seem to be kind of if you're on the A team, your face, right? How do you divvy things up?
Our followers have some awesome names for the 3 of us. You should see some of the stuff that we have to look these people up, and some of them are non-human characters too. It's pretty funny. Jordan's obviously the engineer. He's the on paper he's way smarter than me or Dave. Dave would sit underneath him. Dave has a lot of technical expertise. He was. I always joke that Dave was kind of producing the Wolfman Jack radio show at age 13. He was a child prodigy in media production. I'm more of the sales. I'm more of the ambitious kind of sales guy, bleeding edge, taking things to Dave and Jordan, making them very uncomfortable with the meetings I'm setting up and pushing them to really look at stuff. And we counterbalance each other in that way, I think.
Yeah, you do seem to be a good balance to each other. So do you guys split up the due diligence at all?
We do.
Do you always invest together?
Yeah, it's not like, I wouldn't say it's not like a split up deal. I'd say that we each individually do our own and then work with each other on it. But it's not like, hey, you study this portion. I think we're all taking our own skeptical viewpoints and applying it in different ways.
And we have really transparent, you can call them arguments, very heated debates with each other. And the greatest part about this is we don't invest as a fund. So we're not fighting for the ability to invest our fund's money. At the end of the day, we all know, Dave, you don't have to invest if you don't want. I want Dave to beat me up before I put my money into this company. So even if Dave's not investing, I want to know exactly why he's not investing. We had a debate earlier last year about the cauliflower pizza bread company we invested in. Dave didn't invest. Me and Jordan did.
We eat a lot of cauliflower pizza. What kind?
Outer Isle.
Outer Isle's the company. Yeah.
All right.
They do a bunch of like co-branded stuff, so you probably haven't seen the actual Outer Isle brand.
Yeah, okay. Dave didn't invest, and that was fine. But I had a different viewpoint. And by the way, we do all this on our YouTube channel. So like our followers can see us fighting over this stuff and then going separate ways when I write the check and Dave doesn't. And I'll be like, you're going to regret this someday. But
I always hope that he wins when we do disagree. It's not like you're gonna lose all your money. No, I want you to do well, but this particular one, I tried the product and I was out. It just didn't. I did like some of the cauliflower pizza that I tried, but this particular one, I was not a huge fan of, but I would love for that company to be a success.
Yeah.
But Josh, what we do all the time is because we have no parameters in what we invest in, we obviously are not experts at all things, but we will almost always pull in an expert. So, we invested in a company that was in the contact lens business, and we met with multiple opticians, very senior level opticians about that. We invested, we do have expertise in automotive software, obviously, but even when we invest in companies in the automotive space, we will go back to our old partners, our old clients, and we will ask them to help us vet these software platforms because it's been 7 years since we've been in the industry. We will always pull in an expert through our collective network to help us vet because it's not like we're just investing in B2B software, right? We're investing in everything. I mean, Dave owns a bar. I own a restaurant, right? We invest in that stuff as well, but rarely do we have what I would consider to be deep expertise in the areas we invest in. So we're constantly consulting. And, when we invested in one of your company, probably our most exciting, hopeful investment, another one that I think will help save lives, is a company called, what's the robotics company? Diligent Robotics. And we actually went to a local hospital and that they had engaged with and started interviewing the head of nursing and really beat them up saying, I want to know exactly why you're trialing this product, what went wrong, what went right, how do you think as a procurement person for the hospital, what hurdles are these guys up against? So listen, I don't work in a hospital. We have a med tech buddy in LA. That's all he does. He's also a doctor, and we pulled him into it as well. Laz 3D, we actually interviewed 2 different surgeons to make sure that we weren't off base in terms of the need for that product to help surgeons practice pre-surgery. So we're always pulling more resources, and that's probably one of the most important things that we do.
Nice. Hey, I'm going to try to practice some of my dumb money skills and note that we've got 137 people, 38 people watching right now. We've only got 27 likes or thumbs up down there. So go down and give us a little thumbs up. Oh, there we go. Smash the like button. I want to see some more likes down there. I don't see any yet. I'm up to 28. Thank you. Boom. Subscribe.
Come on, guys.
Subscribe to us. I got my little stream deck, Dave, going. I need to get some of those buttons just, sliding on in. But yeah, please. Oh wow, we got a lot of likes. Thank you. Boom. It's 42. It's like practically doubled since I said that.
It's wild. You actually have to ask, or people don't know that like button helps other people find the video on YouTube. But it really does. And now you'll see we're going to have a bunch more people join the stream.
Do that and subscribe to Dumb Money, and also leave some more comments in there because we're watching the comments. And if you leave a good comment, we'll actually even put it up in front of everybody. I don't know if you guys are you using OBS, Dave? Is that what you're making your little things pop up with?
I'm actually using what's it called? Camlink. I'm using a Camlink encoder, and then this other thing's called Ecamm. It's like Mac software.
Cool. I have to check that out. I've been playing with OBS, which is like this open broadcast system thing. But we're using this app, a service called StreamYard right now, which is what does this broadcast and lets us pull in comments and things like that. So I can pull in Jonathan with some, hey, big dumb money energy today, and pop around different things. But it looks like we've got a question out here too. So let's just go ahead and, as part of playing with StreamYard, pull in Leon's question. So he says, if you're a seed investor, how do you prepare? Do you have a lawyer if you're a seed investor? And how do you and make, particularly, I guess, as you're looking at term sheets and stuff. So I think this is a pretty good question because it's probably different answers for different people. But do you guys use a lot of lawyers?
We're everything. We're very small investors sometimes where we'd use no attorney, and we love that, right? Because we're basically following on a larger investor who's spending all that money and doing all that work for us, and we just sign the paperwork. Sometimes I don't even read the paperwork. I'm terrible with that. But often,
wait a minute. You don't read it because I always wait to make sure that you signed it to then just sign it without
that's
hiring
your
a lawyer
job,
myself.
Dave. You're way more articulate when it comes to that stuff than me.
And we do actually do that. We sometimes someone will actually read the contract and just it's fine. But I think that more often than not, it's kind of just a We've seen enough of these deals. At first, we probably relied on outside counsel a little bit more, but now you kind of get in the flow and used to the terms, and until you're comfortable with it, I would absolutely consult a lawyer. But eventually, it just becomes second nature.
Right? You can come to things like this. There's things about term sheets explained where you can make sure you know the terms and the different parts, and then there's the part of like getting the feel for what's market, like what do people commonly do right now, and for this market, for this type of startup, is that a fair thing? Is that a common term? Like not just knowing what the term means, but knowing, well, what do people commonly do, right? And so I think people get that from, like you said before, I think, Chris, sitting in on a lot of deals, watching other people, being part of these things, and then as you start to do them yourself, I know another thing for me that makes the legal work a lot easier, especially at the early stages that we're often investing, where we're investing in these, very early startups, is many of them use standard documents, right? Like they're using a document that is actually the exact same document that everybody else used, with like little blanks filled in for the amounts and things like that. So that makes it a lot easier because you can say, hey, I'm using a standard document, so now I don't need to have a lawyer go review it. I just have to know what are the actual terms in there that changed, right?
Yeah.
So even the non-standard documents, a lot of times, I don't know that there are more than 4 versions that I've ever seen. It's like all copy and paste, and you start to recognize, oh, this block is important to us. We like to add this to our contracts, and it's the learning process.
But here's the thing. I mean, it's going to work one or two ways. If we're investing $10,000 to $25,000 each, and that happens quite often, we're just going to assume that whoever's leading the round did that work, and if they did a bad job, we'll live with it, right? And we barely even look at the document we're signing. If we're making a larger investment, where we're investing $100,000 to sometimes even $1 million each, in those situations, we always have our attorney. We might spend up to $10,000 on legal work. Either if we're the lead, sometimes we'll spend more than that. Even if we're not the lead, we'll want to make sure that we're very comfortable with every aspect of the deal, even if we ultimately don't control that document before we make the final determination to make that big of an investment. So the great thing about being a seed investor is more often than not, you don't have to concern yourself with a lot of that, because someone else who's investing more money has done the hard work for you, and you're just going to have to be along for the ride, right? And we're that way all the time.
Well, I think that's a really important distinction. Let's talk about leads. So what is the difference between leading a deal and following? And then I want you to then talk about, like, sometimes people act like there's a lead and there's no lead. Like the entrepreneur is the lead, they're just setting the terms and there wasn't actually a lead or anybody that reviewed it. So talk about what are the differences there?
You want to make sure that you know who the lead is. Are they a qualified venture firm that has, enough experience to where they understand how to negotiate both the terms of the deal as well as the valuation of the deal, based on the known information about the founders, the product, the traction, and all that stuff. That is being, that's basically being a lead. If you're going to be the lead, you are controlling what you're valuing the company at. That's your negotiation to have. Everyone else falls under whatever you negotiate. So it's a really important role.
They have to put in a certain amount of money.
I'm sorry, what?
You have to put in a certain amount of money, a certain percentage, like.
Usually, I think customarily, a lead, if a company is raising $1 million, usually the lead will be at least 300,000 of that, maybe more, sometimes as much as $500,000, and then they'll split the other $500,000 between a whole bunch of smaller investors. I think the lead is usually at least, I would say, 20 to 25% of the round, and sometimes as much as 50% of the round.
So what I'm putting in a significant amount of money. Like sometimes I see people think they have a lead, and the lead put in $25,000, and it's like, well, it doesn't just mean they were the first investor. Like,
right, yeah. The lead doesn't mean first.
Make a mistake if you allow someone to set the terms that's only putting in a little bit of money, who then gives you the wrong terms that people who want to put in a lot of money don't want to agree to, right?
I would be very careful on the deals where they don't have a true lead, because it means no one has enough of a vested interest to care enough to make sure that the deal terms are appropriate for the investor side.
Yeah. Now, as you kind of, I think, hinted at before, if you're putting in $25,000 on a convertible note using a standard convertible note doc, that's not as risky of an area, right? Like, there's not that many decisions to make. Use the standard docs. It's okay if there's no lead, probably. And you understand that, that's the stage you're getting in at, right? From Capital Factory's investment strategy, there's lots of different ways to do it, and we're not leads. We want to see a startup getting a real round. We want them to be getting enough money all at once that they're going to have enough, be able to make a real go at it. And then we want to be a part of that. And we want to have somebody else who's a lead, somebody else who's putting in a lot more money than us. So they care about it a lot more than we do. Because not that we don't care about it, just we're making a lot of investments. So we want to make sure each one has somebody else who cares about it a lot more than we do, right? And is gonna, be another advocate and be helping with it. And also, like you said, if they're a professional investor and they've validated it, they've set the terms, they've put in a lot more money than we're putting in. So they have a lot more incentive to make sure all those terms are right. And you're getting the same terms they are. And so that's why they're your proxy.
Yeah, and a lead will generally, if we do a deal, and we've only led a small handful of deals over the past 8 years, we will spend anywhere between 1 and 4 months doing intensive work, whether it's negotiations, legal work, vetting, background, deep modeling into the company. That's 1 to 4 months of work for us to lead a deal before we close, and that's That's a lot. And that's why we don't lead a lot of deals. Maybe once every couple of years, we'll take the lead on a deal, and that will drain our energy for the next 2 years, right?
Yeah, it's a lot of work. Good. Well, a good thing to keep in mind as you're angel investing. You're getting started, great idea is work with other investors that you trust. Don't lead, or if you do, make it a small investment, and work with standard docs. I think those are all parts. He says, what do you look for in a term sheet? I know for us, again, where we're typically following, we have a checklist that's just like, well, let's just make sure they covered all the bases, right? Like, okay, we know these things are supposed to be in there, and okay, they've got that clause, they've got that clause, they've got that clause. And so we'll check for those types of things, which we can do without a lawyer. Are there any particular things that are deal breakers, poison pills or deal breakers for you? Like, we won't invest if this is in there, or we have to have this in there and we always ask for it, in addition to whatever else is there?
It depends if we're a lead or not, right? I mean, if we're not the lead, we're just going to be fine with anything, quite honestly. If we're investing significant capital, quite honestly, we could be one of the toughest in terms of terms that we need to see. And that's a direct reflection of our past experiences. Having been at the wrong end of deals that went bad and, caught up in legal and, founders that you thought you trusted that are now disappearing on you with your money, and all kinds of things happen, or, all of a sudden remember the whole Facebook movie, right? Where all of a sudden you thought you owned this percentage of a company, and they just rewrote the equity shares to where now you only own this much of the company because they just decided to increase the equity float by 4x. So we do not want a founder team, if we're investing a significant amount of capital, to have full control over a company. We need to make sure there's some balance there, whether it's a board of directors or whether it's our approval, before they can do things like massively dilute our investor base, or before they can do something, like give themselves 30% of the company through equity options that weren't part of the initial employee pool. There's verbiage that we've kind of tweaked over the past decade that we insist upon on deals that we lead. On deals we don't lead, and I think every venture firm, there's a lot of different ways to achieve that. And I think every great lead investor is going to have their own way of achieving that sense of, okay, we have a set of rules here that it would be difficult for somebody to do something, unethical, for someone to do something that would just be wrong. We have some checks and balances. So we have our way of doing that. And I'm going to make an assumption that if we follow someone else's investment, that they did it in their own way.
For Capital Factory, there's really one main thing we look for, one extra clause, one thing we will always stick into the deal and ask for in addition if it's not there. And this is always at the seed level. This is, very early stage, investing. I think at later stages, not as much. But and that is a 2x liquidation preference, particularly on convertible notes. And so we typically use the standard convertible notes, like the Series C notes or the YC note or others. But we have a Capital Factory note that we distribute where we've modified it in that one way. And that's I believe the only or the main difference is adding to make sure that there's a 2x liquidation preference, because something that we would see as a quite frequent situation in an very early stage company that then has an early exit is that if they have a sale before the note converts, they technically just pay back the note with interest, which is nothing, and the investors get no return, even though the company can have a very successful exit and the founders and others can receive, many millions of dollars, and the investors just get their money back. And I don't think when we're investing, that's not what we're intending. I don't think that's what the founders or the entrepreneurs are intending either when they take our investment. We're supposed to make some money if the company sells. And so we put that in there as that clause. That clause falls away upon the next financing. As soon as the money converts and they're in a bigger round, we're the same as everybody else. But that's the one thing we always really insist on is a 2x liquidation preference.
Yeah, I think it's amazing. We continue to learn that there are so many different directions a deal can take that you would not expect it to take. There's so many ways a deal can exit that you would never have dreamed of a deal exiting. And you have to have those protections, Josh. I completely agree with you. You certainly don't want to be caught up in the deal for 6 or even for 5 or 6 years. And then there's some sort of exit where, for various reasons, other people benefit from the exit. Maybe founders get big earnout deals at the new company that's acquiring them, right? Maybe they're just leveraging it for some other reason. You want the ability to say, hey, at least give me my money plus the equivalent of opportunity costs, which would be a 2x over some period of time. And there's various ways to do that, right?
2x is not a home run. That's just
No.
hey, okay, this wasn't a failure. No,
a no-brainer.
Well, hey, last time we asked, we went from 27 likes to 66 likes. So big improvement. But there are still people watching. So I have a goal of getting to 100 likes. So please, if you haven't yet, give us a couple more likes down there. Click on the give us a like, smash the like button. Thank you, Dave. Well, I ask this next question, which is how would you recommend non-accredited investors invest? Would you advise non-accredited investors to invest in startups?
Jordan, you're the most conservative, so you start, because I know where I'm headed with this question.
Yeah, I mean, well, I think you probably got the most experience with this, Chris, because of your experience with crowdfunding, right? And unfortunately, it's really not that easy to do, right? And so basically, the startup has to, set aside a certain amount of shares to be able to put through some sort of crowdfunding platform, and it's not really what we were hoping that crowdfunding would be. But it's not really, it's just not really available for a lot of people, which is unfortunate.
And the problem is that the problem is that crowdfunding platforms, for any number of reasons, tend to not always attract the best startups, right?
Yeah.
So that's a huge problem. So if you're an unaccredited investor and you have to invest through crowdfunding platforms, not to say there aren't good companies, because there absolutely are, but more often than not, there are companies that are crowdfunding because they were not able to raise funds through a conventional fundraising process, which is just, you're getting started with like a weight on you, from day one. Like it's a negative way to start. This is a subject matter, Josh, that I'm super passionate about. I am so upset that in this country, you can do basically anything you want with your money except invest in another person who has potential to start a huge business that could be a life-changing thing for you. You can spend your money on TVs or alcohol or literally anything but that. I think it's a disgrace. I'll get so heated if I start thinking about this topic because, yes, investing could be really dangerous. You can get defrauded. But every time you lose money as an investor, you learn. I've been defrauded personally. I don't know of hardly any investor that has been aggressively investing over a course of decades that hasn't been defrauded at one point or another. You get smarter, you learn, right? And so even when you invest in a company that goes bad, the founder learns, you learn, everyone learns. And assuming that you're not getting started at age 75, over the course of your life, if you just start investing, you're going to become a much more proficient investor over time. And I don't see any scenarios where someone that takes a liking to investing in early stage companies regrets it 25 years down the road. I just don't see that as even a possibility, quite honestly. So I think everybody should invest. Find a way to invest. I'm going to be honest. When I started investing in startups, I lied. I was not an accredited investor. I'm not saying that others should do this, but I did it. I said I was accredited. I signed the form. I mean, it's like self-reporting, right? Are you accredited? You gotta check a box off on a government form. I checked the box because I thought it was the most unfair thing that our country can do to people. And I was not willing to get pitted down in that place for the rest of my life where I couldn't participate in what I think is one of the most lucrative pieces of our capitalistic society, which is, investing in high growth. early stage concepts. So I lied, and that's how I got started in early stage.
Yeah, the biggest problem there is that there are like arbitrary limits. Also, it's a net worth or income or whatever, and
totally arbitrary.
Yeah.
So you could teach a class. You could teach a class on venture investing, but technically at a college, but technically not be accredited and allowed to invest yourself. Isn't that insane?
Yeah. Well, I think they're trying to protect people, make sure they have the money to lose and whatnot. But I hear you. It's a fine line. But in many ways, I find, pardon me, crowdfunding is even worse because there's just so little transparency. And also I find a lot of people I see people go into crowdfunding thinking they're investing in high growth tech startups, but those often aren't the kinds of companies that you're actually investing in. So then you've got unrealistic expectations about, what's going to come out of that too. So I think crowdfunding is a great thing. I'm glad we have it. I think it's still very immature. I think, you want to go put $500 or $1,000 into something, probably not a big deal. But I don't see it as a really exciting, lucrative way to go make a lot of money. To me, it's more like Kiva, it's like more about helping fund small businesses or, things like that. And in that level, if I had smaller amounts of money to invest, I'd probably go buy Tesla or Amazon stock or stock market or something like that.
That's what I was going to say, because the startup companies, I think the thing that I'm most excited about is finding that founder, finding that idea, finding the people that you want to invest in. That's often what it is. When you're talking about a crowdfunding platform where you're putting $500 in along with a bunch of other people, and you really don't have any way to personally vet that concept, get to know the founder. And so I think you really are better off investing in a public company. And there are plenty of great growth companies out there.
I dropped another for a company that I hope you're all familiar with. I think you are, and hopefully customers of rocketdollar.com. But have you guys heard of Rocket Dollar?
Mm-mm.
Oh, you need to know about Rocket Dollar. It's Henry Yoshida's latest company. He's a mentor at Capital Factory and serial entrepreneur. But what they do is they make it so that you can very easily take money from your 401k and IRA and use it to make alternative investments in startups, cryptocurrencies, other things that you traditionally would be harder to use that money for. And so it's a way that you can make higher risk investments using in a tax deferred way, using money you might already have set aside.
That's really cool. And just like when it comes to investing, I give one piece of advice to anyone that wants to start investing. If you're fortunate enough to live in a city like Dallas or Austin, or a place where there's a Capital Factory like community center where there's constantly lectures every night and people speaking and pitching, I would say don't invest $1 for 18 months, maybe even 2 years, but find the Capital Factory type place in your city and just hang out there minimum of 2 nights a week. Okay, minimum 2 nights a week. Go. There's a schedule. Just go listen to investors. Listen to stuff like this, right? Listen to investors talk. You're going to get a diversity of opinions. You're going to start to meet founders. You're going to start to meet investors. They're going to start to give you their ideas of what to look out for, what to do, what not to do, and just get comfortable with the space before you make your first investment. But you have to just go there. Just go there and just start listening and learning and engaging. And by the time that 18 months is over with, I bet you'll have a dozen companies that you're trying to figure out which one you should put your money in. And by the way, you'll probably know different investors that are already invested in each of those companies. All right, you're going to have a huge world of knowledge. And it's not you being pitched like over a radio commercial. It's you being part of the ecosystem, right? That is how you invest in early stage. It's just you got to engage first and invest later.
All right, so we got a lot of questions. So let's try to get through some quickly to make sure we get through a bunch. So some fast answers. What's the average dollar amount you invest?
Man, it seems like 100K is like the go-to amount. But we
25 to 100. 25K to 100K.
We do a lot lower also, yeah.
Yeah, 25 bite size. Like there's
that's each.
Yeah, very few. Often a startup will require a minimum investment of 25K. Yeah. 100K, you're a significant investor. 250K, you're a whale, right? You're a large angel investor at that point. And I think that's probably common across the board. All right, safe versus convertible note. Which ones do investors prefer?
Convertible note is technically slightly better than a safe, but there's really not that much difference if there's a good amount of trust into the business turning over out of that round, in the near future.
The latest revisions to the safe that base it on a post-money valuation?
No, I haven't seen
they
that.
recently updated the safe in a pretty significant way where they made the valuation pegged to a post-money instead of a pre-money, which is fairly investor friendly actually. But the thing that it does that is good for the founders is you actually know how much of your company you're giving up.
Yeah.
And the investors actually know how much they're getting, and so it actually is a pretty fundamental shift worth checking out that I believe has made the safes a lot more attractive to investors. But I think your point was well taken to start with. There's not a big difference. As an investor, I don't really care that much. Either one's okay. To an entrepreneur, I'd recommend you go with something pretty standard and stick to it.
Yeah.
Okay. What's the earliest stage you've ever invested? Have you ever invested in something just an idea?
Yes.
We're doing that right now.
we try so hard not to ever do that, but it happens. The same way that you, Josh, say you'll always make an exception for great, great, right?
Exception for awesome. That's my
awesome. We have a similar thing. We're like, we only invest we try to only invest in concepts that have traction, actual measurable traction. But there's, exceptions always happen, right? But we've gotten to a point over the past decade that we've learned that we do better when we hold out until that company has actual revenue, actual traction, whether it's revenue or client traction. It allows us to measure better against the two things we care about, which is cost of acquiring customers at scale and lifetime value. And we have a better sense into those metrics, post-traction versus pre-traction.
Got it. So it does happen, but bit higher bar to get over. Okay, what about this one? Reading materials. What are your favorite reading materials? Shout out one from each of you.
Well, I'm going to give one that has nothing to do with early stage investing, but I've always been obsessed with it. Nassim Taleb's Black Swan. I think it will change the way your mind works, in the way that you think about opportunity, and the way in which you think that there's always someone smarter behind the curtain. So I think that book could help make some structural changes in the way you think.
What's it called?
Nassim Taleb is the author. Black Swan.
Black Swan. Okay. What about you, Dave?
Well, I would say you should probably read Chris's book, because it kind of teaches you how to think, not so much about private companies and startups, but finding those opportunities and being able to find information before it has been fully understood by the market.
To make a little, slider for your book come across. What's the name of your book?
Thanks for the plug. Laughing at Wall Street. Widely available. Laughing at Wall Street. Thank you, Dave.
Awesome. Okay. And what about you, Jordan?
I try to keep up to date with Paul Graham and kind of what he's thinking. I'm all over his essays. I'm all over his Twitter. And then, he's just such a good resource. He gives book recommendations all the time. So if you keep up with him, you've kept up with like half of Silicon Valley and like where the trends are.
I agree. I love everything he writes. He was just tweeting today about cancel culture and some, somewhat bold statements about that. Someone asking why Jordan and I look alike. It's because we're bald and all bald people look the same. That's it. That's just how it goes.
Jordan, what was the name that guy gave you? The ball. It was a very cool bald name. What was it?
I don't remember.
Oh, it's so great. I'm gonna look it
up.
Bald
Baller or something.
Bald. Yeah, the Bald Baller was Jordan's name.
Is that good? I don't think it is.
All right. Next question we have is from Umar on our investor relations team. How are practical ways for ambitious young investors to gain IQ vetting and sourcing early stage investments? What if you don't have the liquidity but you want to learn? So there's the kind of shadow investing for the stock market. Can you do that with startups?
Yes, I think you absolutely can, but I think it's less It's less quantitative. Like, it's not like you're investing in the stock market. It's going back to what I mentioned earlier, engaging in the community, trying to figure out what companies would you have invested in, following those companies throughout their evolution, and then seeing what you missed, right? If you could have invested in that company, you were right there at that time. It's less, like I said, it's not very systematic, but if you're in the ecosystem, you'll get to learn every startup in town, and you'll know the ones that you want to invest in but can't. And then you'll know later on if that was a good or bad decision, and you'll be there when they go bad, if and when they go bad. And then you'll learn from that process, because you'll be friends with the investors of those companies, and they'll tell you what went bad, and then you'll learn through them.
So
you won't be able to paper trade it the same way you can with the stock market, but you really can kind of follow along. And even if you lose touch with the actual founders, if you go to the internet and their website doesn't exist anymore, you know that was good. You didn't put your money in it. You know?
So there are all these secondary offering companies that buy and sell opportunities in the post market. So you can keep up with their newsletters, and they kind of give you all the deals that they get access to, so you can follow along kind of and look at the valuations that they're putting on things. Microventures. What are the other ones, Dave?
Forge Global.
Yeah, Forge is a good one. Yeah, but there's a lot of them. You can keep track of public startup,
and that's a way that you still have to be accredited, but that's a way you can get access to these almost IPO, pre-IPO companies. Not at the startup phase, but beyond the traction stage. When they're actually using letters to talk about the rounds that they're raising.
Yeah, I was just speaking with one of my contacts in the defense industry, in the military, and that person was telling me about it's all these interesting companies that they're seeing. And he said, wow, if only I was an investor and I could invest in these companies. And I was just kind of joking, but it was so true advice. I said, hey, you should right now, like, go write down, can make a spreadsheet, and just pretend every company like that, pretend you invested $100,000, and go ask them, because you know them, and just find out what the terms would be if you were to invest $100,000, and write it in your spreadsheet and keep that list. And 5 or 10 years from now, when you're ready to retire, you'll be able to take that spreadsheet and go look and go raise a fund with it. These are all the deals I would have done. Here's my.
I took a call this week with a student somewhere. I don't remember what state she was in. They are developing a game. It's a startup game for investors, where they essentially take companies that started up in the past. They know the traction and how they grew. They white label that company, so you wouldn't know who they were, and you make a decision every day. You read a brief on a company as if it was pitched, whether you want to invest in it or not. And over the next few days, that company either grows or goes out of business based on what actually happened. I thought that was really cool. And they have hundreds of these scenarios, and they do video pitches to where they have a fake founder pitching the thing to you every night, right? And so you can kind of speed trial through 25 years of VC learning, right? Through that game. I thought it was super cool.
That's very cool.
Sounds really smart. All right, a couple more questions here from Jonathan Chavez up in Dallas. Do you think that high frequency trading will eventually arbitrage away opportunities in the public markets?
No way. Like, for those of you guys that don't know, like me and Jordan, our old company Ticker Tags, that's the world we were in, which was data to hedge funds and quant funds. And high frequency trading, just theoretically in 20, 30 years with AI, anything's possible, right? But not for a very long time. The ability to surface information, connect the dots, and actually interpret that as a human, any type of automation on Wall Street is nowhere close to doing that. I think they're at least 15 years away, if not way longer. So you have enough time before you need to start worrying about that.
Great. All right. We have a little time for a couple more questions, but we're going to wrap it up soon. So if you have any questions, now is the time to get them in there. Now is also the time to hit the like button or subscribe and help us get up to 100. We're up at 82, so we've made a lot of progress just today. And so, one of my questions for you guys is about deal sourcing. So where do you find companies? I mean, you said you find a lot through Capital Factory, and I bet you get a lot through Dumb Money, through having your public channel, right, where you are out there putting yourself out there and attracting things. If you didn't have those two, how does an angel investor find deal flow?
Yeah. Really just knowing people that are in the space, and I'm actually really surprised at how many of my friends, and by friends I don't mean like my tight group of friends, but like friends of friends and things like that, are starting companies that I've checked out. I'm not always investing in them or anything, but it's interesting to see just how pervasive it is in society right now, that people are taking a chance and trying to start a company.
Yeah, I'll double down on that. You have to understand this, investing is networking. If you're not capable of networking, then you're not going to be a good investor, because that is half of it right there. So you went to college, maybe you have people in your neighborhood, your family, your coworkers, people you play tennis with, golf. I don't care what it is. The hardest part of investing is networking to the point where you're able to surface opportunities that are great at that moment when you can be a part of them. That's the work. That's being an investor. So that's just not like how you start. It's kind of everything. So if you want to be a great investor, get out there and build a massive trusted network and make sure everybody knows that this is something you're interested in. So you get the phone call, so that you're part of that conversation when someone in your massive network knows someone who's doing something really interesting. It's that simple.
So I totally agree with you. That is true. And that is very effective for me. That's part of how we work. Maybe as one of the last things to talk about, put that into the lens of diversity and equity and all the challenges around that right now. Because in many ways, while what you just said is very true and is part of what is a secret to, not much of a secret, but is one of the keys to getting, good deal flow, it's also part of the problem.
Josh, it's not only part of the problem. I literally was riding my bike 2 days ago through my neighborhood, this beautiful neighborhood of Highland Park, University Park, remembering back when I was a kid, and I was thinking about all this stuff that's been going on. When I was a kid growing up in this neighborhood, I used to ride my bike around and, take the DART bus to school and all this stuff. But I had access to all these people. I learned from these super uber successful people in this neighborhood. And I was thinking that is a privilege that goes well beyond white privilege, right? I mean, I just might be one of the most privileged people on earth. And the three of us are, quite honestly, me, Dave, and Jordan. And that is something that we're thinking about right now at Dumb Money. One of our missions is we're going to try to figure out how to bridge our privilege to people that don't have it. Because we feel adamantly that investing and knowing how to do what we do is not just, it's everything. It doesn't matter if you're an electrician, a plumber, if you work at a janitor in a school. If you can figure out what we do, you can dig your way out and get to anything you want to do in life. Financial freedom by age 30, 35, 40. So we're focused this next year on figuring out how we can, kind of take our privilege and figure out how to get that to those that don't have it. Because you're totally right, Josh. If you're not in these circles, you are way behind. And it's a massive hurdle. I mean, you think education is a hurdle? Networking to people that are doing interesting things that you could maybe connect with in life, that's a way bigger hurdle for you if you're in that spot.
It is. It's a big part of the challenge. I know for us, one of the things that we've done that's been very effective is we do $100,000 investment challenges where we put up a significant amount of money and designate it, saying this is only can go to a team that has a black founder, or only can go to a team that has a female founder. Or we do it around other things too, like artificial intelligence, or next week coming up, we're doing one around human performance, things that augment human performance for our military partners. But they're very effective for us. We did a Black in Tech challenge just a few weeks ago and awarded a $100,000 investment prize. and met a company that, we just probably wouldn't have met otherwise. Like putting up that amount of money really catches their attention, and it feels risky, kind of like, knowing like you've got to write the check, someone's going to get it. But we're always really blown away by who it brings in. And it's made a big difference in our community, just even over the past year or two, in the number of diverse entrepreneurs that we have. So that's one thing.
I would love
I
to.
listened into that Black and Tech deal that you guys did, that contest. Man, I mean, there's like 4 or 5 of those companies that I would have invested in. I actually put that in my notes. I'm like, I would be interested in investing in this, but nobody followed up with me.
All right. Well,
there were some
I think Dumb Money and Capital Factory should partner up, and I'd like to put some money in to one of those contests. I think that that's a great opportunity, and we have some reach in YouTube. You have a lot of reach in Texas. I think it'd be really great.
Just decided it. The next diversity in tech challenge that we do, we're doing in partnership with you. You're going to help us get the word out.
What I would like to do though, Josh? I would like to. I think what could be even more interesting than that, because I think it works very well for founders. But it goes well beyond founders. Almost like, I think if there was a big brother, little brother type program where you can take someone from that world that's not looking to start a company and just introduce them to this world and see what it's like to be an investor and to actually sit in on pitches with that person and tell them what you like about the company it's pitching or not pitching, right? And so, like, I think the investor world, I think, is where there's a complete absence of this. Like, by the way, I love what you guys do for the founder world when it comes to that, but no one, I haven't seen anyone anywhere figure out how to pull people on the other side of it, right? Because
about something you might not know about, but our good friend Brian Chambers runs a program up at UT Dallas called that, as part of his UT Seed Fund that he started, that's very similar also to a program, not very similar, but similar to a program in Austin called the Genesis program. And both of them put up real money and engage students and basically put them in the jobs of vetting the companies and helping to decide where the money goes and what they do with it, and really puts them in the seat of being an investor. And so again, if any of you are involved in that, that's one way for students to get more engaged. Up at UT Dallas, it's the UT Dallas Seed Fund with Brian Chambers. And down in Austin at UT Austin, it's the Genesis program.
Awesome. I love it.
Cool. Well, I think that's probably a good note for us to wrap on, but I want to thank both of you for joining us today. Both of you, all three of you, and just for being such great members of our community. We love investing with you. We love everything you guys are doing. And I'm so glad that, I'm sure we just got to meet a whole bunch of new people that are part of the Dumb Money community that now know more about Capital Factory. Hope we'll see you engaging what we're doing. We want to help you connect to customers and investors and talent and other people and people like Dumb Money. And hopefully a whole bunch of people from Capital Factory learn more about Dumb Money, and we'll be watching your YouTube channel. What is it? I apologize for having to ask. Is it dumbmoney.com? No.
You can go to dumbmoney.tv. It'll redirect you. We actually have 2 YouTube channels. One is about startup investing, and that is youtube.com/dumbmoney. And our public market investing is dumbmoney.tv. Actually, youtube.com/dumbmoneylive. That's where we talk about public markets.
All right. Now, and if there isn't, there will be soon. We want merch apparently too. So.
We have merch.
There's a way to get it. We tried to price it so we're not making any money off of it. It's I think dumbmoney.tv/merch. That's where you can get logo stuff with our name on it.
Awesome. All right, guys. Hey, thanks so much for joining us. Thank you, Tret, for pulling all this together. And thank you, everybody, for following and giving us a bunch more subscribers and likes. And check out Dumb Money and Capital Factory. We'll see you all soon.
Thanks, Capital Factory.
Thanks, Josh.
All right.